Hi guys, welcome to the risk management part of this course. This is going to be a different video to the videos we've been doing so far, where we are kind of just going to talk together. We're both on this video for once, so we're going to talk to you like
sort of like a podcast.
Yeah, just something like
be more
this.
chilled.
Risk management can be a very boring topic, but it's actually a very important topic. So I do wish you take away as much as you can from this, and you do listen. And as I said before in all the videos, you do write things down because it'll only benefit in the long run. So we kind of wanted to start off with just the basics of risk management, I guess, and what risk management is as a whole. And obviously, as you know, I hope you know, no one goes into a market and trades all of their account on one trade. I mean, you might see Instagram traders do that, but that's not how you trade, and that's not at all how you should approach the markets. What's called the Vanguard Way of Risk Management, which is a very old book, which was developed in the 80s, I believe. It said the maximum risk you should take per trade is around 2%. And if you just do some quick maths, if you risk 2% every trade and you lose 5 trades in a row, then obviously you're down 10% of your account, which you don't want to be, because 10% can be a big figure out of £1,000, out of a £10,000, £100,000 account. So yeah, as a basic rule of thumb, we do say you don't want to cross over 2% as you start trading. And to you, it might seem like it's a very small figure, especially if you are starting with a small account. That's something we'll go into later on. So it is important you don't go over 2%, and you do have rules into place. And as you develop your trading plan, that's something else we'll talk about later on. You know what risk you will take per trade. You know the risk you'll take per day as well, and per week, because you don't want to be down a certain amount of trades, certain amount of percent, in a given day on a given week, because clearly you are not exercising your edge correctly, and clearly you're not in sync with the market. So we're going to talk about putting things in place so you don't actually go over those risk parameters.
Yeah, I think one of the most important things to sort of understand when you're very first starting off as a trader is you are going to be gambling for a living. As much as it's educated guessing, or you've got a strategy that you've back tested, and yes, you manage your risk, you are still taking on inherent risk every time you press buy or sell. The whole career is a gamble. So when we come to risk management, it's not just I'm going to risk this per trade. My risk management rules is to never risk more than 1%, let's say. That's a good start, and you're understanding how much risk you want to be taking on per trade. But risk management is more, in my perspective, making sure that you can make a career out of trading, and providing longevity to the game. It covers aspects such as your expectancy. So if you backtest the strategy, you'll know your expectancy. And this is all part of risk management. You might think it's learning technical analysis or building trading plan, but it all comes to risk management. Because if you know your expectancy over 10 years, for example, if you've got 10 years of historic backtested data, obviously we can't say that historic data will, be representative in the future, but that's all we have to go on. Yeah. All we have to go on is historical data. So if we know over a course of 10 years, we have an expectancy of X, Y, and Z every year, or every month, every week, every day, we can sort of plan and build a trading plan and a career around that. And then things like taking losses and how much risk percentage you're going to place per trade all start to become clear, and all comes together to formulate a plan. It goes much, much, much deeper than just saying, I'm going to risk this per trade. And walk away saying I manage my risk effectively because I don't risk over 1 or 2%. It goes so much deeper than that, so that every day, without even knowing it, you're managing your risk. You're not taking trades because you're bored. That's risk management. You're building in certain strategies, to not take trades around news events if it doesn't suit your strategy. That's risk management. Everything that we do is risk management. And we need to make sure that we're best equipped to tackle the markets with risk management in mind. So yeah, that's how I want you to approach this module. And like Chris said, sometimes it does get a bit boring because it is the boring side of trading. It's the more realistic side. You will take losses, you will lose money, especially at the beginning. You'll probably take more losses than any period throughout your trading career, because you're less experienced. But our job is to help you be able to move forward with that, with the right tools in place, so that, you know, as you learn and grow as a trader, you do become more profitable without putting yourself in harm's way when it comes to losing a large portion of your account. But yeah, that's my perspective overall on risk management anyway.
So the first aspect we want to talk about when it comes to risk management is actually your minimum risk to reward ratio. Now, if you have done, let's say, in previous courses, or if you just read online about risk in general, you'd have heard the term minimum risk to reward, which is what is the amount you're willing to risk against what is the minimum amount you're willing to take off the market, essentially. So what's the reward you're seeking from the risk you're taking? And people talk about, if I risk 1% on £1,000 account, so I risk £10, my minimum risk reward is 3-1. So I'm not coming out of the trade until I hit my 3-1, which is until I hit the £30 that I'm looking for. Now, this is a fundamentally wrong approach to the markets, because you're implying your own perspective onto the market. You're forcing the market to go your way based on what you're looking for. So if I just show you a quick example, if I just go onto this daily chart, let's say I've managed to buy the bottom and go on target, make it smaller, bigger since you're on about, and then make this more 3-1 minimum risk to reward. There we go. So I've entered the trade there on the daily time frame, and I'm looking for that minimum 3-1 risk to reward ratio. What if the market comes in and just carries on going here? It doesn't move anywhere for days. Well, am I still going to be sitting in that trade waiting for that minimum risk to reward? Or if the market's turning against me, so something we've spoke about in the understanding market structure and implementing market structure videos, where we talked about the market structure showing us signs of reversal, showing us those new lower lows being created or those new higher highs being created. Am I still going to sit here and wait for a minimum risk reward to actually come into fruition when the market is clearly showing me signs of a reversal, where the market is just going to go up here, make a new high, and then just actually come down into my stop? It doesn't make any sense that you're inflicting your own bias onto the markets at any point. You have to align yourself with the market and trade accordingly. That's why we stress you understand the market structure first before going out there and like trading a strategy itself. You need to see, okay, what are the chances the trade actually goes here? So let's say I was targeting this low in the market there. What are the chances that the trade actually goes there? That's when, what Kieran spoke about, that's when you go into your journal and you look at the back-tested results. You look at your strike rates, you look at your risk to rewards. What have you got in the past? What is the average risk to reward you may get? Because at the end of the day, you're there to take money off the table, and you do need to get paid. So if you see the trade clearly reversing upon you and you're up, let's say 1.5R, 2R, but you're still staying in the trade because you're looking for that 3R, just think about it. It just doesn't make any sense at all that you'd still be in that trade. This is something that we found it happens a lot of Instagram, with all these Instagram traders saying they're not going to exit trades until they get a 3-1. And another thing to consider is you have to be aware of when you do actually exit trades, because as I said here, if you were targeting 3-1 risk to reward on this trade, but you did actually exit, so let's say the market rejected this this swing low in the market here, and it was coming down into your entry, let's say. If you exit the market at that point, you don't take the 3R home. You only took about 1.5 or 2R. So your money you earn on the trade is going to be much lower than your minimum 3-1, which is going to impact your strike rate. And people don't consider that you will exit trades early, or sometimes you'll pull orders, or you'll only enter the trade and actually it'll go not all the way to your stop. There's there's different things to consider, and that's where your trading journal is going to come in. But as the point that I wanted to stress first and foremost is you have to eliminate the idea of a minimum risk reward. When the market's giving you what it's giving you, take your profits. Obviously, you don't want to take your profits too low and then regret doing it after. But you want to understand what the market's doing. You're not going to understand what the market's at any point, but you're going to understand what you have been taught and what you have learned yourself about market structure and the chances of the market turning on different points, basically.
Yeah, you've got to remember that the market is a living beast and it changes day by day. Let's say, you know, you're long the euro dollar, and then you have the Fed have a surprise rate hike the following day and the dollar flies, or the position just goes against you, and you're a few pips away from your target. The news comes out and boom, the trade goes against you. You know, the market is ever evolving and you need to adapt to it. You need to listen to what the market's telling you, as Chris said. If you're targeting past the prior level, you know, a level that gets respected as both support and resistance whenever it flips the level, and you're targeting just past that by a few pips just because you want to squeeze that little bit of extra profit out of the market, and then it turns on you and you know, you end up coming out break even or you end up hitting your stop. But when you reflect on the trade, when you look at the position, you can see that level was so evident, and that you was actually aware of that level beforehand, or you was aware of the news events, or you was aware X, Y, and Z, what could have happened for price to turn, but you ignored it because of your minimum risk to reward rule. Now, the way I see it is you've always got to adapt with the market and trade what you're seeing, trade what the market is giving you, because you will never beat the market. The market is the biggest beast in the world. It's got the smartest people, the richest people, the most cunning people. And if you think you're going to overthrow all of these just to get a simple rule that has no sort of statistical backing, as in to help your probability of winning a trade, then yeah, you're always going to lose.
So just to wrap up what we basically said in the first part about the minimum risk to reward, you got to remember, and there's a famous quote, I can't remember who it's by, but it goes, the market will remain irrational longer than you can remain solvent. So basically, let's say you enter the trade and you don't have a stop loss and you keep thinking, oh, the market's going to turn here, the market's going to turn here, the market's going to turn here, and your trade just goes against you all the time. And it will get to a point where you're just going to give everything in. You're going to get the margin call from a broker, let's say. And at that very point, that's when the market's going to turn, because the market does what it wants. It's like you're not more powerful than the market. No one is in the world. There's been traders of about billions of positions in the market, yet they still got stopped out because they thought the market's going to turn against them. It doesn't work like that. If the market's showing signs of reversal and you're likely to get stopped out, you get out the market and you have those predetermined levels. So the next topic we want to talk about is actually knowing your strike rate and just being in sync with your strike rate, actually back testing enough and forward testing enough and demo trading enough. So you have what's the word I'm looking for?
Expectancy model.
Yeah, expectancy model, and just a strong number of trades that you can successfully look back at and actually determine your strike rate. So what I mean by strike rate is what are the chances that your trade will go to your target. But that's as simple as it gets. So what are the chances that if I enter the trade here, it will go to target wherever my target is, and that's where your strike rate comes in. You'll see people online, some will say you don't need a higher than 50% strike rate, you don't need higher than 40% strike rate, and for some it might work, but from our experience, the higher your strike rate is, the easier it will be for your own psychology to actually continue to trade in the markets. What I'm going to do is actually bring in something Trader Dante uses in his course, and something that's actually worked for us brilliantly, because it really puts into perspective how strong your strike rate needs to be. So on the left hand side, let's assume this is the percentage of your strike rate. So let's say I've got an 80% strike rate. This is the first example we're going to use, and this is the probability of seeing at least 2, 3, 4, 5, and so on consecutive losers within a 50 trade period. So if I've recorded 50 trades in my journal, and from my journal I find out, okay, I've got an 80% strike rate. What is the percentage? What is the probability that the next trade I take, I hit 2 losers in a row? So we look at this. We look at the first column here. So with an 80% strike rate, there's still nearly an 87% chance that I hit 2 losers. It's still a massive figure. So, but to me, if I go into the market and hit 2 losers, I'm all right. Okay, there has been a high chance that I will hit those losers. But after that, the chances of me hitting three losers decreases dramatically. It's under a third. It's 32%. So the chances of my next trade actually working based on my journal are very high. So I'm more confident approaching the market this way. But then let's say if you have a 40% strike rate, the chance of you seeing 2 losers is 100%. The chance of you seeing 3 losers is 100%. And even the chance of you seeing 6 losers is still higher than the chances of you seeing 2 losers on an 80% strike rate. So you look at, if your strike rate decreases by half, the chances of you seeing 6 losers compared to 2 losers rises dramatically, and it's still 80%. So there's still over 50% chance you might see 8 losers in a row. And just take this in for a while and actually think to yourself, am I comfortable trading a strategy where there's a 50% chance of me seeing 8 losers in a row? And some of you may be, but some of you may not, especially when you're starting up. And that's when you start switching between strategies. So our strike rate is one of the most important things to us, and that's why we stress you utilize a journal from the start. If you can come into trading, let's say most people from experience come with a 55-60% strike rate, and the chances of you seeing 4 losers in a row are very high. Yet some people may see 4 losers in a row, and I've seen it happen, and they'll just completely abandon the strategy and move on to something else. And it's just not, there's no longevity in that. You have to, I'm not saying you have to stick with the strategy if you have 4 losers, or you have to adapt to the market. You have to see what's going on. Maybe there's certain market conditions which you can't trade under your strategy. So you need to be constantly adapting. You need to constantly be aware of your strike rate, because it's just going to put doubt into your mind when you're trading. And when you have doubt into your mind, you'll be driven on emotion rather than your technical edge, rather than your mental edge. So that's always going to play a part, and you're going to pull orders, you're going to pull trades which go on to be winners. And there's nothing worse, personally, I don't think there's nothing worse by pulling a trade which then goes on to be a winner. Even if that trade goes on to be a loser, you'll just shrug off and be like, oh, at least I pulled the order. But if that trade goes into target and you do get that 2R, well, you miss getting that 2R, that 3R, that's going to have a detrimental effect on your psychology.
Okay, so one of the next topics that we just want to have a brief discussion over, and it's something that's widely recognized as a risk management tool and strategy, method, whatever you want to call it, to help preserve capital, is moving your stops to break even. Do I think this has a place? Potentially, yes. Do I think it should be utilized on every trade? No way. Like we said earlier, you have to trade what the market is telling you, and you have to adapt with the market as it evolves. If you're in a position that is completely 100% still valid and price retraces back, let's say down to your entry, maybe a few pips in drawdown, if that position is still valid, there is no reason for you to move your stops. And again, we'll refer back to trader Dante. He says, I'm not going to use the same language that Dante uses, but he says if you move your stop for no other reason than so that you can't lose money on the trade, you're and this is where I would use that language.
See you next Tuesday.
Yeah, he uses a few choice words, but it's true. You cannot approach a game, you cannot approach trading in fear of losing money, because it happens. Now we need to adjust our mindset to accept that loss so that we don't make mistakes such as moving your stops to break even. Now, over time, and I've been guilty of this myself, is moving stops to break even in fear of thinking, okay, the moves happen now, it's retracing back to my entry, I probably, you know, that the move has been rinsed. Now it's going to go and take out my stop, so I'll move it to break even. Then price comes down, tags you out the trade, goes a couple of pips into drawdown, and then absolutely rockets, and you miss the rest of that move. So you've actually come out at zero or break even, maybe a little bit in profit, a little bit in drawdown, but you've actually missed the move that you forecast. Now, this becomes a problem when you don't recognize it. So let's say, and I see it all the time on social media when, you know, I follow a lot of traders, and they'll say, this was a great move, great setup, great analysis. Unfortunately, I got taken out of break even, but we move on to the next one. Now that indicates a big psychological problem for me. When I was having this problem, I taught myself not to do it because it was having a negative effect on my expectancy. Yet you see people who constantly do it, constantly get taken out of break even and then miss the move. Now they're acting out of fear of losing money, but it's negatively affecting their strike rate, because if they left all their positions to run as normal, their stops were valid and their stops were never taken, but they was taken out of break even, providing liquidity to the market before price, you know, rallies or drops in a harsh way. And like I say, it becomes a problem when they don't see, you know, I say they, you, me, you know, if you don't recognize that it's causing that negative effect, you're going to carry on doing the same thing. You're going to carry on doing it because every time you're walking away saying it was a brilliant setup, but you caused that move you caused yourself to lose money essentially. And that's the biggest thing that you know, you need to tackle. And yeah, it's partly psychology as well, but because it's into, you know, it's moving your stops, it does come under risk management. It's something that we kind of like to nip in the bud straight away. But like I say, it has its place. You know, if you're holding a position through, I don't know, NFP, for example, and you're 20 pips up, I would say you need to look at potentially taking profits or trailing your stop or moving it to break even, depending on what method you back tested or what you usually see works. We like to trail our stops right below price in that sort of example, because quite often price will rally upon such news as an NFP release, so we can bag a massive move. But you know, also you're protecting yourself if the figure comes out differently and price might plummet through your stop. So yeah, it's a very discretionary thing that you do, but just know that it doesn't always have the desired effect that we're led to believe that it does.
I think, well, you can't just say approach the markets without fear, because everyone is always going to have that fear of the trade going to stop. But people will put their mind onto stuff like this when they are trading their profit and loss rather than trading the market. People sit there and watch, let's say, the MT4 platform, and you'll see these minus figures or these red figures, minus 200, minus 300, minus 400, and you'll think, oh, I can buy this with this money, I can buy this with that money. And that's when it just, like this once again links to psychology, it just becomes too much for you because you can't handle the thought of losing all that money. So what I do want to say is you need to focus on taking the best trade that you can take rather than thinking about what is the most money that I can make in the market. Just to throw you an example, LeBron James doesn't get paid the most because he's thinking about his paycheck. He gets paid the most because he's the best athlete that he can be. He's focused on his performance. So when you focus on your performance rather than the results will follow naturally. But if you focus on the result even before the performance, then you'll never achieve what you set out to achieve, as the result will disable you from taking on the risk associated with success. And I'm not just saying that's the only person that does it, because you'll see athletes, you'll see CEOs always working the hardest that they can, not thinking about whether they'll get paid. They're taking on that risk before they're thinking about the reward. And with risk, yes, sometimes it doesn't work, but you have to risk something in order to gain something that is greater than you can possibly imagine. So yeah, just think about, you have to you want to take the best trades that you can possibly take. Like, I don't look at my P&L ever. I just look at the market and look at where the market's signaling I can get in, or where the market's signaling I need to get out of this trade. And then after that, I know what I've made on this trade, and that's it. So focus on the best trades you can possibly make.
So another concept that we want to go over is one that's often overlooked, and it's the concept of evolving R. Now, when we first take a position like the one that's on the screen, you know, if we manage to sell up here, this is just an example position. There's no technical analysis, so don't read too much into the actual P&L. But let's say we sell this level here, 18, 6, 7, 9, with a 10 tick stop. At the beginning, we have a risk to reward or an R of 10. Now, as price comes down, let's say as price goes into profit down here, starts to retrace. Now, just move this down to this high. You can see that although our original stop, so we're in profit since this point, right? So we've earned money here. Now, that money belongs to you. It does not belong to the market. That is your money that you earn and that you can walk away with right there and then. So you're actually risking that money. So let's say, and I'm just pulling numbers out of thin air, you're up $100 or £100 in this area, okay? So your stop was £50 and you're up £100 here, so you're up 2R. You're now risking your 2R and your 1R loss. So you're now risking £150 in this position. Now, I don't say that to encourage exiting your positions early, but it's a concept that you need to be aware of, right? If you're seeing signs of reversal and you're thinking, okay, this position's starting to not look as good now, just consider this. Let me just move that P&L back to where it was originally. Just consider this as price is retracing here. Would you jump? Oh, wrong P&L. Would you jump back into the trade with you stopping the original position, you targeting the original position, but now with an R of 2.4 over the original 10 because of what you're risking? So then, obviously, with this now 2.4 R trade, as it's evolving over time, that P&L is now obsolete because we are risking our own money, which we can walk away with at any time. As price comes down, yeah, let's say we come 90 ticks in profit, but you're waiting for that 100 tick. You've set your 10R minimum, let's say, risk to reward, and you're waiting for that to be hit. As price comes down here, this is where you need to be looking to either exit your position and take your profits, or thinking, okay, is price going to continue in my favor? Is there going to be some mean reversion? Is price signaling any signs of reversal? Because that's an indication that you need to get out. If we was to exit the position and jump back in to grab those last 10 pips, look at the risk to reward now. It's now a 0.16. So is it really worth risking that 9.5 R that you're up, and then the 1 R that was your original stop loss for that extra like 0.5 R? Is it worth it? And that's what you need to be asking yourself for a position. Now, like I say, I'm not trying to encourage the fact of exiting positions early, because it's an issue that's sort of a separate issue that people struggle with, because psychologically we look for small wins, which we'll cover in the psychology webinars anyway. Yeah, so we don't want to be exiting positions early. That's a different issue that we need to tackle as and when you come to it. But the thing that we're really trying to hammer home is that you need to be managing your positions effectively, looking at taking your P&L out of the equation and actually listening to what the market's telling you. If the market's telling you that the price is reversing, for example, and we're up 3 or 4 R and we're holding out for another 0.5 or another R, 2 R, however much, is it worth holding on and risking losing what we've earned? If you're risking 1 R and now you're up 3 R, technically you actually got 4 R at stake, because you can lose the money that you've earned, and then you can lose the money that you've staked originally within your stop. So I think it's a really important concept. Like I say, it's one that is difficult to sort of get your head around, because I don't want to encourage over managing of positions. But this is where multi-time frame analysis really helps, because if you have daily targets, for example, that you've back tested and you know that price is most likely going to reach there, it's going to stop you from exiting positions early. But also it's going to help you know that your R is evolving. Show you bags, whilst maintaining effective management of your position.
One of the last few things we want to talk about is actually exposure to risk on same moving pairs. So in the sentiment lecture, I talked about how pairs are linked together and how there's money flows in between pairs. But what you also need to be aware of is actually trading similar moving pairs, either against each other or with the same risk flow. So I got the US dollar index as an example here against the euro dollar. So this is the euro dollar chart here, and down here in orange is the US dollar index. What we tend to see is as the US dollar index gets stronger, so that means the value of the dollar gets stronger, we see the euro dollar decline in value because the dollar is stronger, so the currency pair declines. Similar thing happens to the pound dollar, similar thing happens to the Aussie dollar, and so on and so on. So you need to be aware of how the market moves. So let's say if you want to go long on the euro dollar, you want to buy euro against the dollar, and then you want to buy the pound against the dollar as well. You don't want to over risk yourself on those two pairs. If, let's say, the US dollar is shooting for new highs, so for example, if it broke this high here and it's carrying on shooting upwards, as it's showing strength in the market, the euro dollar and pound dollar are likely to be declining in value or declining in price. So you need to be aware of this correlation, which is something I talked about in the sentiment lecture. But then you also need to be aware of these correlation between, let's say, the Canadian dollar and oil. If there's news coming out for oil and is very high impact news, and you've got a position on USD CAD or CAD JPY, for example, you need to be aware of that news because it may stop you out. So this is something I talked about again in the sentiment lecture, but we're just coming back to it now because it's so important that you're aware of what's actually going on, because you don't want to be caught on the other side of these moves. You want to either go into the market, let's say if the euro dollar and the pound dollar align themselves really nicely, you might want to split your risk. So you put 1% into one and 1% into the other. You want to put 0.5% into one and 0.5% into the other. But it's important you don't go over your dictated daily risk for the day. So you need to manage that as well as I just said, when you're trading a commodity against a currency, to be aware of the news that's going on. So you're not going into the market with high impact news, for example, for the US oil, which is not US oil, sorry, crude oil. There's news coming out for crude oil and it's likely to impact the markets negatively, so that US oil is likely to go down. You need to be aware of how that's going to impact your given currency and how that's going to impact your given risk. So always come back to it when you are in a position. Be aware of these risk flows and these money flows. But if you took on board what I said in the sentiment lecture, you won't have a problem doing that at all.
So to finish off talking about risk management for now, this is sort of not trading related. I mean, it is obviously trading related, but it's not looking at charts and looking at managing your risk within yourself. This is something that we sort of encourage people to do as they want to approach professional trading, which is going for funding now. The reason why we've decided to include it under the risk management lecture is due to the fact, if you have a pot of capital, let's say £1,000, and you decide that you want to trade with that £1,000, and you're managing your risk effectively. So let's say you're risking 2% of your original balance every trade. So you're just putting £20 up each trade. That's how we would teach somebody to trade, right? But the alternative route that you can go down is looking at funding. Now, we've brought MyForex Funds onto the screen. We're not affiliated with MyForex Funds. They're a completely separate entity. We're just using them as an example. But you can see for their $10,000 account, it actually costs $84, which is a refundable registration fee anyway. So if you pass their account challenges, which we would never recommend you going for these challenges until you're ready anyway. This is more sort of a longer term view of your trading journey. But to trade with $10,000, you only need to put up, it's effectively you're putting up a margin of $84, which current day works out about £52. So if you felt that you felt ready to trade live, you'd had profitable months demo, you might have even started trading live and been profitable with that. We might say that to manage your risk, to not expose you to it, because human error is a big one in trading that you need to manage. And it's quite often overlooked. You can make, I've done it. I once lost 10% of my live account balance on a gold trade because I miscalculated my lot size. So it happens to people. None of us are immune to human error. Whereas when you're trading with a funded account, it's not your capital that's at stake. It's capital of the prop firm. You've only put up your money to take part in the challenge, which if you pass anyway, you get it refunded to you. But then you have their account to trade with. So effectively, you are not trading with any risk at all. You're putting risk up per trade, obviously, and there is a chance that you can lose the account if you are trading without stringent risk management. They do have loss limits on them. So you can see the overall drawdown limit on the $10,000 account is $1,200. So you can lose 12% of the account before they cut you off effectively. However, with this account, you can lose more than what your original balance would be if you used your own pot of money. But the potential upside is way higher. It takes you from that retail trader to the professional sort of funded trader instantly, whilst minimizing your risk. Now, this is something that we are doing a funded course as well, which will go over this sort of stuff in more detail and actually train you to sort of be ready to take on these challenges, because they are difficult. I'm not going to say that they're not, but when you're ready, it's much more effective in capital preservation to go for one of these challenges rather than staking your own capital. Now, obviously, if we're looking at the 200K account, just in this example, that's $1,000 pretty much. So you have put $1,000 at stake. So the risk does get higher the higher the account you go, but we would never recommend you go for an account like that anyway until we know 100% that you're ready and that you feel 100% ready. But I just wanted to use the $10,000 account as an example because I think it shows that nice enhancement from, let's say, $1,000 or £1,000 personal pot to $10,000 pot. If you make 10% on each, 10% on the £1,000 is £100. 10% on the 10,000 is $1,000 or £1,000 if you did a challenge. There are other prop firms like FTMO that do do it in pounds, but we're just using dollars for now. So yeah, that's sort of, it's not a tactic of risk management, but it's something to consider. Because once you've paid that, I mean, £52 for what you get is really good value for money, in my opinion.
I think it just puts things into perspective, because if, let's say, you've got a £1,000 account and you risk 2% per trade, if you lose 3 trades in a row, you're down £60 because each 2% is £20. So if you're down 3 trades in a row, you're already down £60, which is just over what you'd pay for the $10,000 account. So we didn't want to show you this and be like, you need to get this, you need to do this. It just puts things into perspective slowly, because there's things out there which you can do, as Kieran's saying, where the risk is different and it is something not many people talk about. So we just wanted to mention this because it is an option going forward, certainly.
Mm-hmm. Cool. So that's all the topics that we wanted to cover in this lecture anyway. So we'll see you in the next one.